Hi, I'm Kelly Wright at the Money Show, and I'm joined today with Mr. James Stack of Stack Financial Management. Probably one of the best guys in this industry, and this is a real thrill for me. So it's good to be able to do this with you.
It's great to be here with you, Kelly.
I appreciate that. So we had a pretty dull and boring market last year.
It was the lowest volatility year since the early 1960s. If you look at the number of 1% moves in the Dow up and down, we hadn't seen that low volatility in 40 years.
I know a buddy of mine said if you had graphed volatility, it would look like a dead man's EKG.
Oh yeah, it's like it's like the electrocardiogram of a rock. But boy, has that changed this year.
So we had the election, okay, and the market went wild, but nobody believed it. I mean, it rode a wall of worry,
The market rode the wall of worry after the election. A couple things happened with the election.
Okay.
Even though the electorate was pretty split, what happened is we saw a huge surge in business confidence.
Okay.
The NFIB, National Federation of Independent Business, took its biggest jump in confidence in the history of the gauge. And if business confidence jumped, so did CEO confidence, and consumer confidence went up too. And investors were just along for a wild ride.
But then in January, something happened with sentiment.
Yeah.
Okay, I mean, I don't know if somebody went out in the hall and they flipped the switch, but something changed in January, and all of a sudden, what happened?
I think this year, the exuberance caught up with the reality.
Okay.
And this is a very expensive market.
Okay.
It's also a very long bull market. It's the second longest bull market in Wall Street history.
Right.
Now, the good news is bull markets don't die from old age alone. The bad news is we are much closer to the end of this bull market than the beginning. And we're starting to see some of those incremental pressures develop that can bring about the end of the bull market, including the pressures on the Federal Reserve, pressures on interest rates. And we're also dealing, as I said, with a very expensive market. It's not a buyer's market out there, and I think that's starting to weigh on investors when all of a sudden they can go out and start getting 2% in short-term treasury bills.
Okay, so that brings me back to another topic. It's been a long time since fixed income was an alternative for the equity investor.
Yeah.
Okay? I mean, just the returns were not there.
You basically have a Federal Reserve that has kept interest rates near zero for far too long. Some might argue with that, but let's face it, there has been nothing attractive about your bank CDs or your money market funds for as long as you can remember, because the Fed was trying everything to stimulate the economy. Now we have an economy hitting on all cylinders, and the Fed's starting to go, uh-oh, maybe we need to bring interest rates up, and maybe we should have started a little sooner.
And the Fed's not necessarily the best timing. How would we say? They're not the best timers in the planet.
The Fed just has a very poor track record of anticipating what's happening economically. And I think in this case, I think they are behind the curve.
It kind of looks that way. We can do this all day. We're going to cut this for right now. I'm with James Stacks of Stacks Financial Management. Thanks for joining us.